Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We are recording this on Tuesday, November 11th. So happy Veterans Day. This is Remembrance Day in the UK. So we thank those servants for their service. And thank you again for joining us. And today we're delighted to be joined by Rich Nuzum, who is head of OCIO at Franklin Templeton. Welcome, Rich. Thanks for joining us here.
Thanks for having me on. Thanks.
And as usual, I'll bring up the slides. Well, I've called this podcast Too Big to Fail 2.0 and beyond, as we look at the large concentrated tech companies within US equity markets in particular, we start thinking about whether any of them have become too big to fail and what would be the processes in place to prevent that. We're also going to show some slides today focused on China. And one of the questions there is whether China, with its AI capability, and its consumer power, whether that has essentially become too big to fail. And we can see that there have been pretty strong performers there in the bond and the equity markets too. So a lot of play on those particular set of words. As usual, we move through inflation, interest rates, equity markets, geopolitics, and other asset classes. And I know Rich will have something to say on the price of oil when it comes to other asset classes there. Some of the sub conversations are around inflation. Is it in the eye of the beholder? Do we really know what the actual expectations around inflation are today? Bringing up the K-shaped recovery theme, we will look at some soft consumer sentiment numbers and ask if the economy really is okay. When it comes to emerging markets, we've got some interesting stats regarding flows, regarding performance. I already mentioned China, and we'll ask whether any of those economies are too big to fail. And moving to private credit, we're going to continue to dive into this $3 trillion plus area and ask whether the rating agencies and those entities that essentially are giving a grade to the private credit issuers, what is happening there and whether there's anything to be concerned about or whether we have the rigorous oversight that we would hope for. And as always, we will be relating this back to portfolio construction, thanks to having Rich here as a guest. So here's Rich's bio, head of OCIO at Franklin Templeton, having previously spent over 33 years at Mercer in a range of roles, providing investment consulting advice to institutional investors and the wealth segment. Looking at inflation, these are some slides from last week because we looked at some of the inflation numbers. Key takeaway from this is whether 3% is the new 2% essentially. Are we now resting with a higher than average inflation rate and paying attention to the increasing share and importance that electricity prices are having in inflation? And before I turn it over to Rich, these are some of the pointers that have come out this week with respect to inflation forecasts. It seems that when it comes to companies' obsession with inflation, a Bloomberg count of the mention of the term has come down dramatically. So it's no longer top of mind for corporate executives. And equally, there's a sense that when it comes to expectations, there seems to be a political polarization at play in that there's a strong expectation among Democrats and independents that inflation will rest higher. They essentially do not maybe believe the claims that inflation is coming down. They are concerned about the impact of tariffs. Whereas on the Republican side, there seems to be more of a hovering towards that 2% level. So I suppose more confidence in inflation coming down. And this is quite notable because there's quite a big delta there in terms of expectations. And the final point when it comes to tariffs, it is that certainly there has been a push through into imported goods. They are notably higher than domestic prices because of the effect of tariffs. So now put it back to you, Rich. How are you thinking about inflation? Where are we likely to rest? And how much of a factor will this be for clients seeking to invest their portfolios, essentially? How much will they have to think about inflation?
So a number of observations. The first is that averages lie. We think of inflation as one number. We measure CPI, we measure PPI in different countries. We talk about core versus non, but inflation is a basket of a bunch of underlying prices. Energy prices are particularly volatile. Cost of housing is volatile. And so as we discovered when we had 9% inflation coming out of COVID in the US and higher in some other countries, inflation falls differentially by individual depending on your consumption basket. Do you commute to work? How do you commute to work? What do you have kids in school? Just every family is different, and every business is different, and every country is different in terms of their import basket, their consumption basket. And so higher inflation falls differentially. Low inflation is less of an issue. That's one observation. The second is that energy demand, you had the chart up about electricity prices. ChatGPT became available to the general public in November 2022. And that and sort of the general AI digital revolution and the thought of what AI is going to do to transform our economy, that has doubled expected energy consumption by 2030 versus pre-22 forecasts. That's a huge change in our collective expectations for the energy we're going to consume as a society. And we're a couple years into that, and electricity prices are moving up. We also have not had a peace settlement in Ukraine or a peace settlement in the Middle East that includes a cessation of sanctions against the Iranian oil sector. And so oil prices remain elevated relative to prior to the Russian invasion and prior to the Gaza conflict, where oil prices are down year to date, but we're still above $60 a barrel, whereas pre-invasion we were at 40 and historically in the 20 to 40 range. So energy prices are elevated, but energy demand is going up quickly. So we have these inflationary waves. You also mentioned tariffs. I think the tariffs themselves are increasing prices in the U.S. and are a deflationary force for the rest of the world. These are U.S. tariffs by and large, and so monetary authorities in the rest of the world have the ability to ease policy because inflationary pressures are lower due to the U.S. tariffs. The Fed is actually fighting a war on two fronts with the dual mandate and paying more attention to what's happening with employment and economy, kind of trying to thread the needle and so unable to get inflation down to its 2% target because of now keeping an eye on more explicitly what's happening with strength in the labor market. So the Fed's fighting on two fronts, whereas monetary authorities in the rest of the world could further relax monetary conditions if they thought they needed to. So again, inflation falling differentially in the U.S. and the rest. I think what gets ignored in the tariff discussion sometimes is the uncertainty shock. So the Liberation Day announcements froze some corporate buying activities, some consumer buying activity, and then we had another uncertainty shock in the last 45 days with the U.S. government being closed for longer than was expected. And hopefully we'll get a vote to reopen and get reopened by Wednesday or so, or at least have certainty on reopening. But that uncertainty shock again has caused consumers to defer purchases, not just government employees who weren't getting paid, but consumers have deferred purchases, and that creates a supply shock that actually feeds through into inflation. So those uncertainty shocks, I think, are important as at least transitory inflation drivers.
When it comes to the vibe check on the economy, a very divergent economic experience in the US, certainly. And this is that classic K-shape that we've been speaking about for some time. The latest consumer sentiment data at the University of Michigan was close to record lows. And the last time it had been as low as this was June 2022. So very much mired in the middle of that double whammy equity market and bond market in 2022. And we can see that what I think was really interesting when we speak about this divide between Main Street and Wall Street, that clearly if you hold stock in this economy, even if your Main Street experience is challenging, that stock side of your portfolio, of your holdings is doing well. So maybe a little bit of an offset. We can see that consumer sentiment from the biggest stockholders is higher, quite a bit higher than those that would not hold stock at all. And just a few more shapes here on the looking at the again the same point. If you do feel great about the economy, you must own stocks. Wall Street Journal article there, and we can see that 87% of stocks and mutual funds being held by the top 20% of earners. So clearly, quite a bit of divergence when it comes to that. So before moving to the shutdown, what is your sense as to some of these hard and soft indicators that we're seeing in the economy? As you know, the hard indicators have been a little slower in coming given the shutdown, but the soft indicators have been, I'd say, consistently quite soft.
Yeah, the Michigan survey was extremely interesting. There's a question in there about unemployment expectations 6 months out, and I think 72% of participants thought it would be higher, which was the worst number since 1980 in terms of pessimism about the labor market amongst consumers. And yet, almost at the same time, the National Federation of Independent Businesses did a small business survey in the U.S. 32% of small employers said they're having difficulty filling jobs. That's the best number if you're looking for a strong labor market, or the worst number if you're an employer trying to find labor since 2020. So it's this juxtaposition of employers saying we can't find the right people for jobs. We're leaving positions unfilled. We're leaving demand on the table because we can't fill the seats, and yet employees saying we're pessimistic about the labor market. We can't find a job that we like. It's tempting immediately to go to a discussion of U.S. immigration policy and whether some of that mismatch is due to lower supply of labor for less skilled roles. But it's definitely a really interesting juxtaposition there. And then you showed the stock market data. We've got the S&P 500 up through close of trade yesterday, 16.3% year to date. EFA in dollar terms is up 26. Emerging markets is up 31%. So stock investors, particularly if they were globally diversified, have done really well. And yet labor's not feeling it. And we have this amazing earnings growth coming through. S&P 500 earnings double digit 4 quarters in a row, 10.7% in Q3. Earnings growth expected for 2026 of 14%. I mean, that's amazing, even against a PE ratio of 28. So we've got this amazing earnings growth coming through the economy and benefiting providers of capital, and yet labor's not feeling it. We've got the worst consumer sentiment since 1980 in the University of Michigan survey.
Really interesting point. And I think now getting to some of the other kind of vibes in the economy, because all of these juxtapositions, as you said, are, I think, just adding to the uncertainty, adding to the difficulty of really just extracting a narrative from all of that. We've had somewhat a surprise shutdown to the shutdown in that after the resounding, I'd say, outperformance of Democrat versus expectations on the elections last week. We then have 8 senators decide to shut down the shutdown without many hard, I'd say, hard in stone commitments around healthcare spending and healthcare expenses. We can see that despite the fact that it didn't seem that markets were that bothered by the shutdown, risk assets have really rallied in response. We can see that there's a suggestion perhaps of more money coming in that this $2,000 payout perhaps could be paid to individuals in order to offset some of the effect of inflation of tariffs. And we know there's quite a lot of money washing through the system. So what's your take on this response to the shutdown? As you noted, we're not quite there yet. But do you think that this indicates that the economy maybe has more to run?
I think the shutdown was starting to have a very serious impact on both business and consumer sentiment because the government, you actually need decisions out of government, licensing decisions, approvals to move forward as a business. And for consumers, the general sense of uncertainty is dysfunction was starting to wear on. And then the issues with travel were very visible. So even if you weren't traveling, you were looking ahead to Thanksgiving, maybe had some family member traveling. And if people can't fly, there's going to be more people on the roads. Traffic's already horrendous in most of the country for Thanksgiving. So it was starting to matter in visible ways, in emotive ways, and in concrete ways as an uncertainty shock. So in that sense, resolving this is really good for the economy, and it's not surprising that the market responded favorably. Democracy works better than any other system, but it's awfully messy along the way. So we've had the midterm election results in the US where my read of that is that politicians that ran on a platform of, I understand it's about affordability, I understand it's about kitchen table issues, and that's what I'm going to focus on. They seem to do well. And so I think I hope our politicians take a message from that and focus on that. The suggestion of 2,000 per American payouts is interesting. The two concretely pro-growth initiatives that we've had from the Trump administration and Republican controlled Congress have been fiscal stimulus with continuation of the Trump tax cuts from the first term, and then a regulatory rollback that makes it easier to do business in the U.S. as a business person. Individuals could disagree about the merits of those, and there is concern about the sustainability of long-term U.S. debt. But in the near term, those are factors that are helping drive corporate earnings growth, corporate optimism, employment. Those have been pro economic growth measures. And I interpret the suggested 2,000 payout as another suggested fiscal stimulus measure.
It's a really interesting observation just in terms of all of this, how this is contributing, I suppose, to that trying to shore up the consumer. When it comes to equity markets, this was taken before we had the shutdown news, but we know that there was a bit of a sense check running through equity markets. So this has been kind of bubbling up for some time. We've had the records hit. We've had the equity markets steaming ahead. We've had very strong earnings. I know you mentioned that. And there has been a best earnings in years, the strongest earnings growth since 2021. But just getting back to what that's looked like in terms of markets. So clearly, there has been a sense that perhaps there was this interconnectedness of AI was of concern. There was a look at Michael Burry with his high-profile shorting of Palantir as one, and some very defensive reactions among those companies to this, and just a sense that maybe some of this had got ahead of itself. And we can see that in the past week, tech stocks, Microsoft, Meta, Nvidia, Palantir, all had fallen, in some cases quite down near double digits. However, that we can see that the quantum stocks too have been trading in a league of their own. So definitely this kind of bifurcation in the market. I always like to ask this question among allocators, CIOs. How do you think about this new behavior of a segment of the equity market, this concentration, this quite reasonable volatility, if we're seeing stocks falling by 10, 12% in a week, and just that breakaway of certain sectors like quantum, like AI? How do you think about that in a portfolio construction context?
Well, it produces real challenges to portfolio construction and makes risk management and ideally proactive risk management, so risk management before you trade, not after, much more important. And it's not going away. So I think trying to put this in lay people perspective, the concentration is driven by winner takes most business models. If two companies are going to the same space, the one that gets slightly ahead ends up with 80% plus market share. The other one maybe isn't around anymore. So the winners win big and the losers go out. And as opposed to kind of more evenly distributed market dynamics we may have had with other business models historically, but also that concentration and that winner takes most dynamic as digitalization and AI come to other sectors that we don't think of as tech. Think restaurants, think garbage trucks, think anything in your life is getting increasingly digitalized. How I buy my subway tickets and my metro tickets to commute into work, it's completely digital now. I haven't touched the physical ticket machine in years. It's coming everywhere. And so you now have winner take most in business models and increased market concentration in business models where we didn't see that historically. As an OCIO, we favor direct implementation approach where we get the model portfolios from our different sub-advisors. We know what risk exposures we're going to have before we implement their desired trades, and we can aggregate those up to try to stay within the risk bounds of our clients and avoid undue concentration. I think that's an improvement on historical OCIO models where the capital is allocated out, the sub-advisor traded independently, and then you found out the next day, oh, we're 3x the market weighting in the stock, which already had a high weight, and now we've got too much risk there. What do we do about that after the fact? So I think I give that example to illustrate that capital market participants are adjusting to this increased market concentration and volatility in real time. You mentioned shorting. I think it's a huge benefit for U.S. capital markets that we allow shorting. We have a healthy hedge fund sector. It keeps market efficient. It maintains. It gets capital to the highest and best use quickly, which then drives labor to the highest and best use quickly. That produces creative destruction along the way. But there's a reason why the U.S. economy has massively outperformed, for example, the Japanese economy or even the Chinese economy in recent years. And that creative destruction, that quick funding of the winners in this winners takes most dynamic matters a lot. The collective bet on AI and digitalization. So I'm going to say something that's kind of contradicting itself on the surface. I believe that we are still underestimating as a society and underfunding the AI and digitalization boom because it's so transformative in the industry sectors where it's happened. At the same time, there will be individual companies that have a big market cap today, both publicly traded and private, that go to zero, not because AI and digital is wrong overall, but because some other company that's currently smaller and has less of a brand, less well known, disrupts them from below. And so you better be diversified. I mean, the short answer is in this increased concentration and with this volatility, the best answer is diversification. If you want to gamble, I think the stock market's better than a casino for that. But if you want to invest, diversification is key.
And then when it comes to China, we've had this sea change essentially from China being considered uninvestable to now trading almost in lockstep with the US in terms of at least their bonds and not having a particularly high spread there, but equally having a relatively strong performance year to date and a very strong AI story. It seems that China is the entity to beat now when it comes to AI and is definitely a stalking horse when it comes to AI progress. Two other issues I'd love to just touch on before we finish up here. One is private credit. I've many times in the past few weeks spoken about the cockroaches cited by Jamie Dimon. We've looked at some of the high profile bankruptcies and due diligence shortcomings. The latest focus of the mainstream media getting their handle on this $3 trillion asset class and emerging area is the rating agencies and the new crop of rating agencies. We see specialized rating agencies really proliferate in this area, not just the big three any longer. The number of privately rated securities are, of course, growing. And when we look at private credit here, I suppose why are they concerned about this is because I guess these credit agencies haven't yet earned their stripes necessarily or proven to be credible. There's a lot more information out there now, which can sometimes be challenging for investors. And I suppose it's all getting to has this burgeoning area, got very big very quickly, and do we fully understand it? And is the due diligence up to scratch? And I'd love to just hear your thoughts on private credit at the current juncture.
In every investment conference I go to, and then in every client meeting I have, one question that comes up is there a bubble in private credit? And so I've got four main observations around that. One is we will sooner or later see problems in the private credit market where we have a problem in the real economy. And at the same time, we'll see those problems in public equities, public bonds, and private equity to the extent that those have been used to finance activity in that sector. And one area that investors are keeping an eye on is the AI digital space, including building new energy to fuel the electricity demand, hyperscaling, data centers, everything there. Because of that winner takes most, that the sector could do well, and there will be individual companies that go under. And if you hold their debt because they didn't win, you're going to have a workout to work through. So that may not be systemic and across the entire asset class, but we will see problems where there's a problem in the real economy, and we will see individual project problems, even if the sector does well. So we should expect that and keep an eye on the real economy. The second issue, and you mentioned the role of rating agencies, it's really great for the global economy that private credit enabled by AI and digitalization is being used to finance consumer spending that would not have been economically viable to finance without private credit and other entrepreneurial activity through innovative consumer finance, some of it digitally based, and innovative asset-backed financing. And those areas are attractive to our clients because they provide real diversification against the rest of the economy. Those yield curves are not as highly correlated with the normal investment grade yield curve, and they still provide a lot of return enhancement. But with that comes, these are new asset classes, new instruments in parts of the economy where that financing hasn't been available before. Nobody has the claims history. The audit requirements are being made up in real time. The rating agencies are coming at it in real time. And the in-house people at the private credit players that need to underwrite these loans are looking at new instruments on new platforms, new data. So there's a huge expected return available to get that right. And you can use diversification to try to mitigate your risk, but there's a risk that we get it wrong. And so the recent bankruptcies connected with the auto sector got a lot of press, even though the private credit industry was quick to point out these weren't financed with private credit. That was a bank loan. That was a public issue debt. Don't blame us for this. But the auto sector historically has been a place where consumer problems in repaying their debt shows up first in an economic cycle. So it got a lot of focus. But I think more generally, investors are intrigued by the return enhancement and diversification potential of particularly consumer finance, asset-based finance, some of the newer innovations in private credit that are AI enabled, where you can underwrite small loans to people who wouldn't have qualified, you couldn't have afforded to do the due diligence without AI assistance. And at the same time, recognizing this is really new. It's never been tested. Everybody in the value chain is kind of making this up in real time, how they're going to do this well. And so, yeah, the returns are really high, but we could actually, these loans might not get paid back in full or at all. Um, having raised that danger, I'm gonna give two kind of bullish observations that support continued optimism about private credit. One is we actually had an acid test, a really tough stress test for the system in terms of the private credit loans that were made in 2021 versus 2022. So if you think back in 2021, we had interest rates close to zero, we had helicopter money fiscal stimulus into a COVID-stricken economy that turned out not to need it. In the sense that we maintained full employment, we worked from home, there were supply chain disruptions, but life kind of went on in a weird way. And so the loosest credit on record, the loosest policy environment in history for 2021 loans. And then by 2022, we had interest rates 5% higher at the short and long end of the curve. We had fiscal stimulus being rolled back. We had pessimism about the economy because the thought that, oh my gosh, we're going to have a lot of inflation and the monetary authorities are going to have to put us into a recession to cure that. So we went from the loosest to the tightest that we'd had in 30 years. And so you've got the 2021 vintage year loans versus the 2022. And the non-accruals on those, a colleague of mine just wrote a paper on this. The non-accruals on those as of year in the last year were running at 1% of market cap on the 2021 loans versus 0.7% on the 2022 loans. So, you make loans, not all of them pay back on time in the private credit space. That's kind of assumed in your numbers, but a 30 basis point increase, and it's not quite fair because there's one less year in the 2022 numbers, but if anything, that makes it more striking that we went from the loosest policy environment to the tightest, and we're not seeing it come through in non-accruals. We're not seeing it come through in defaults. So we actually had that acid test. People talk about what happens in the next crisis. Well, we tested it the other way around. We went from very loose policy to very tight policy, and we're okay so far. The last comment I'll make is about commercial real estate loans. Coming in this year, there was a huge concern about the wall of maturity this year. We had 650 billion plus in commercial real estate loans maturing this year in a tight interest rate environment versus 525 last year. There was a thought that it's going to be really hard to roll over that debt given that commercial real estate prices are down and properties are empty and properties going unsold and being repurposed. And yet it's November and we're not talking about defaults in commercial real estate, widespread defaults. There are workouts happening. There's stuff happening behind the scenes. We don't seem to have a systemic problem. And in the next 4 years, the maturity wall drops back to about 625 billion a year. And we've got our long-term interest rates down 1% from the peak, 50 basis points year to date, both short-term and long-term interest rates. So it's easier for those real estate investors to refinance, but they didn't have a problem with this wall to maturity. So I think people are rightly looking for what could go wrong in private credit. It's newer, it's bigger. It's not clear that anybody fully understands parts of it yet. It hasn't been tested. There's lots of reasons for caution, and the yield spreads have come in with more money chasing the deals, and so that's caused some CIOs to sit out, the latest opportunities. On the other hand, the problems aren't visible yet, which doesn't mean it won't happen, but we've had some big tests that market participants were worried about, and we kind of sailed through them.
Well, Rich, I don't think there's been an asset class we haven't touched on here. So takeaway from this is the need to be focused on some of these shocks and how they percolate through not only the economy, but the stock markets and also investor sentiment. So thank you so much for coming here and taking us on the sweeping tour of asset classes globally.
Again, thanks for having me join. This was great. I loved your slides, and you teed up a lot of great topics for discussion that are on the minds of our clients.